The first half of 2024 has been a remarkable ride for the stock market, defying expectations and delivering impressive gains. The S&P 500 has surged by about 14.7%, while the Nasdaq has leaped by 18%. Even the usually sluggish Dow Jones Industrial Average has seen some upward movement. This bullish trend has been powered by a resilient economy, robust corporate earnings, and favorable investment themes such as artificial intelligence. However, lurking beneath this optimistic surface are potential risks that could derail this positive momentum. Despite the celebratory mood, there are concerns about inflated price-to-earnings ratios, uncertain interest rate policies, and the looming presidential election. With mixed economic signals and the possibility of increased volatility, investors are left to ponder, can the stock market sustain its current trajectory, or are we on the brink of a significant shift? Stock market outlook for the next 6 months, promising gains amid potential pitfalls. The stock market has defied expectations in the first half of 2024, with the S&P 500 up 14.7%, the Nasdaq soaring 18%, and even the traditionally sluggish Dow Jones Industrial Average gaining 3.8%. This surge has been underpinned by a resilient economy, strong corporate earnings, and favorable investment themes, creating a layer of optimism among investors. However, as we approach the second half of the year, it is crucial to acknowledge the potential risks that could impact this bullish trajectory. While the foundations of this optimism, such as economic resilience and corporate earnings, remain strong, there are several factors that could influence market performance. Strong economic foundation. The economy has shown remarkable resilience, providing a solid base for stock market gains. Corporate earnings have been robust, with Wall Street forecasts predicting steady growth through at least 2026. Even when excluding the performance of major tech stocks, the earnings outlook remains positive. In the first quarter of 2024, S&P 500 companies saw an 8.4% rise in profits and a 4.1% increase in sales compared to the previous year. This performance has bolstered investor confidence, with 79% of S&P 500 firms exceeding Q1 estimates, according to FactSet Research. Despite this, the forward 12-month price-to-earnings ratio for the S&P 500 is at 20.7, significantly above the 10-year average of 17.8. This suggests that the market is pricing in continued earnings growth at a favorable rate. Key investment themes. One of the most significant investment themes driving the stock market in 2024 has been artificial intelligence, AI. The deployment of generative AI across various sectors has spurred demand for shares in companies specializing in chips, cloud computing, software, and data centers. This trend is expected to continue, providing a strong growth engine for the market. Other bullish themes include robust demand for new housing, advancements in life-extending drugs and medical devices, innovative restaurant concepts, and new shoe designs. The restaurant stock group, for example, has seen a market-beating 22.8% gain year-to-date. Similarly, industries such as fabless semiconductors, shoes, and data storage have also shown significant strength. Dividend growth prospects. For conservative and long-term investors, the prospects for dividend growth remain attractive. Howard Silverblatt, senior index analyst at S&P Dow Jones Indices, projects a 6.5% rise in cash payouts this year, reaching $629 billion. Historically, dividend growth has exceeded inflation, providing a stable return for investors. Matt Burdett, a portfolio manager at Thornburg Investment Management, highlights that since World War IE, the spread between dividend growth and inflation has been more than 200 basis points. Small-cap stocks, a potential opportunity. Some analysts see opportunities in small-cap stocks, particularly with the beginning of the Federal Reserve's easing cycle. Small-cap stocks, especially regional banks, have lagged in the first half of the year. However, if regional lenders improve their performance, the stock market could receive a significant boost. For example, U.S. Bancorp, USB, a Minneapolis-based bank, is expected to see its profits grow from an 11% dip in 2024 to an 11% increase in 2025. Even with a current rebound, USB offers a healthy annualized dividend yield of 4.9%, nearly quadruple the S&P 500's yield. The role of interest rates. Interest rates have played a critical role in shaping the stock market's outlook. At the start of the year, investors expected multiple rate cuts by the Federal Reserve. However, the current consensus is for fewer cuts, with some dismissing the possibility entirely. Despite this, the stock market appears to reflect confidence that the U.S. economy will continue to grow, achieving a soft landing or no landing at all, even if the Fed delays monetary easing. The CME FedWatch tool shows 66% odds for a quarter-point rate cut at the September Fed meeting and 78% odds for at least one cut by November. This shift in expectations highlights the uncertainty surrounding interest rate policies and their impact on the market. Impact of bond yield curve inversion. The inversion of the bond yield curve, where short-term interest rates exceed long-term rates, usually signals economic trouble. However, this has not deterred the stock market. Despite the two-year note trading at its highest level since 2007, the economy appears flush with cash, with private equity firms playing a significant role in lending. This trend has mitigated the negative effects typically associated with an inverted yield curve. Kevin Justice, Senior Vice President at Nationwide Financial's Investment Management Group, notes that massive fiscal spending and lingering demand for services since the pandemic have offset the usual debilitating effects of an inverted yield curve. This has kept the equities market attractive, even in the face of high short-term interest rates. Consumer spending and confidence. Consumer spending has been a significant driver of stock market performance. The Conference Board's Consumer Confidence Index rose to 102, with notable improvements across all age groups. Consumers with annual pay exceeding $100,000 posted the largest increase in confidence, reflecting their continued spending power. Arnim Holzer, a global macro strategist at Easterly EAB, points out that higher interest rates have led to increased nominal incomes for savers, boosting their spending capacity. This trend supports the growth of the stock market, as consumers continue to spend despite economic uncertainties. The promise of AI and productivity. The potential of AI to boost productivity could play a crucial role in the future of the stock market. If AI deployment adds significantly to U.S. GDP, it could justify higher interest rates and higher price-to-earnings ratios. The latest reading on U.S. productivity growth met expectations but fell from the previous quarter's increase, highlighting the importance of AI in driving future economic growth. Mixed economic signals. Recent economic data has painted a mixed picture of the U.S. economy. The May JOLTS survey showed a decline in job openings, suggesting employers are scaling back hiring plans. However, non-farm payrolls exceeded expectations, and wages grew by 4.1% in May, indicating ongoing economic strength. Despite these mixed signals, some analysts believe the U.S. economy is slowing. Real GDP growth has decelerated from 3.3% in Q4 2023 to 1.3% in Q1 2024. This slowdown could impact the stock market's performance in the second half of the year. Political and geopolitical risks. The upcoming political risks are expected to grow as the election approaches, with potential impacts on investor sentiment and market stability. Moreover, geopolitical events in India, Mexico, and Europe have caused upheavals in financial markets, highlighting the importance of monitoring global developments. Historically, U.S. presidential election years have been favorable for the stock market, especially when a sitting president runs for re-election. Big tech's influence and investor sentiment. The concentration of gains within a few megacap tech stocks poses a risk to the overall market. The correlation between these stocks and the broader S&P 500 has weakened, suggesting potential vulnerability if these leading stocks face challenges. Despite this, measures of investor sentiment do not point to excessive bullish exuberance. Key sentiment indicators suggest skepticism over the current bull market, which could lead to more investors entering the market and boosting share prices. Opportunities beyond the U.S. International markets. particularly in fast-growing regions like India and South Asia, are drawing attention from investors. The eShares MSCI Emerging Markets, ETF, and iShares MSCI Emerging Markets, ex-China have shown impressive gains, reflecting growing interest in these regions. Mark Galasiewski, an expert on overseas equity markets, notes that emerging markets are entering a sustained uptrend, driven by smaller-scale conflicts and geopolitical developments. This trend suggests potential opportunities for investors seeking diversification beyond the U.S. Conclusion: the stock market's performance in the first half of 2024 has been impressive, driven by a resilient economy, strong corporate earnings, and favorable investment themes. However, potential risks, including interest rate uncertainties, political events, and mixed economic signals, could impact the market's trajectory in the second half of the year. As investors navigate these uncertainties, the key question remains: can the stock market sustain its bullish momentum, or are we approaching a turning point? Share your thoughts on the future of the stock market and how you plan to navigate the potential risks and opportunities ahead.